Hello and welcome to the BamCam podcast with your hosts, Jack Burnette, Alison Castellano, and Adrian Castellano. I'm Wendy McConnell, and the gang is all here. Hello and welcome to everyone.
Hi.
Hi. Yeah, we're all here today. Excited to be here.
Still no baby.
Still no baby.
But it's got to be getting close.
By the time this episode airs, I bet you there'll be a baby.
There'll be a baby.
Yeah. Not hopefully by the time it ends recording.
Yes.
There is a lead time when we record these. So if you're listening to this, we've had a baby.
Yes. Yeah.
So,
well, congratulations.
Thank you. I wish I could tell you if it was a boy or a girl, but we're still waiting to find out.
That's so old school now, but I love it. I love it. So good for you.
It is old school, and I kind of like it.
Yeah. It's fun. And, being an IVF couple and, we haven't had a lot of room for surprises in our journeys. So this is one that we can have.
Keeping everybody on their toes.
Yeah.
There you go. So what are we going to be focusing on today?
We are going to continue talking about financial jargon.
There's just a lot of it out there.
There's just a lot of it out there. We could probably sit here and talk for 2 hours or so, and we're not Joe Rogan, so we're not going to do a long-term podcast or whatever. I'm not sure people would listen that long on that. So we're going to spend the next 20 to 30 minutes talking about some other additional terms that people may or may not fully understand, but you hear frequently when talking about financial services, financial markets, et cetera.
Yeah. So today we're going to focus on, bull markets, bear markets, volatility, recessions, and investor sentiment. And these are things that kind of confuse people and sometimes even scare them.
I only want to talk about bull markets.
I like bull markets too.
No, we got to cover the bad too. But because we like to keep things smart, we're throwing in some Warren Buffett wisdom today as well, because if there's one guy who knows how to possibly handle the stock market, he's not too bad.
Well, he's certainly had a good track record, and some of the stuff that he does really makes sense and resonates, and he's had a long time. He's been blessed with a very long life. And so a lot of his wisdom has come from just his observations of things through those many decades of investing. And I'd say a lot of my wisdom, if you want to call it that, comes from my personal experience as an investor. I haven't always been a financial advisor for my entire adult life, but I've been an investor for my entire adult life, and comes from some observations as well.
You've been paying attention for a very long time.
Yeah,
I have, and so it's the benefit of hindsight sometimes can be valuable.
Yeah. Yes. So let's start with the good. Let's start with bull markets.
Okay, they're the most fun. So they're the most exciting. So a bull market means that the markets are rising.
Yeah. So
it's very simple.
Picture a bull. It's got its horns up and it's charging full force, full of energy. And that's what happens when the stock market is rising.
Right. And it's at the end of the day, a stock price rises because there's more buyers than sellers.
Yeah.
It's quite simple. I often, just out anecdotally in social settings, somebody will say the market was up a day or down.
Yeah.
And somebody will say, well, why was the market up today? And I'd say more buyers than sellers. Or if it was down that day, say, well, why was the market down today? Well, it's more sellers than buyers.
Yeah.
And on a given day, there's usually not that much fundamentally that's changed.
Yeah.
It's really more than just that there was more buyers than sellers or more sellers than buyers.
And I do want to point out, even though, like, if you're in a bull market, the market can still go up and down from day to day.
Yeah.
It's not always going up just because we're in a bull market.
Right. It's not a straight line.
Yeah.
People would like for it to be. Frankly, I'd love for it to be too, but it doesn't work that way.
Yeah.
And so it is a kind of a jagged line.
Yeah.
Even in a big bull market.
Yeah.
So it is, generally what powers a bull market is a strong economy where the companies that we're investing in are growing their earnings, because fundamentally it's the earnings of the companies that provide the value that we're tapping into it by our investment in these companies.
Yeah. And so that creates an increased demand for securities and then widespread positive investor sentiment. And here's where Warren Buffett kind of drops his first piece of advice: be fearful when others are greedy, and be greedy when others are fearful.
Right.
Yeah.
So when there's a lot of momentum going in the market, you kind of sometimes have to watch and say, watch out. Something bad may happen.
It's easy to feel overly confident
Yes.
as an investor when everything is all, rosy, right?
Yeah.
And when prices are rising, and I see this a lot in the crypto markets right now, in that this fear of missing out,
Yeah.
FOMO.
Oh, yeah.
Yep.
You feel like you have to invest because you feel like you're missing out on something, and people don't look at the actual fundamentals of why you're making an investment decision.
Yeah. Sometimes it creates a false sense of security that can lead investors to take on too much risk.
You feel invincible.
Right,
Yeah.
right. So, factors that drive a good bull market are when you have solid employment numbers, the people are spending more, increased consumer spending, business profits are solid and growing, and the companies are forecasting that their earnings will continue to grow. So that many of these companies issue what's called guidance and kind of a look ahead over the next 12 to 18 or 24 months.
Yeah.
And so as a result, the companies, trade at a multiple of earnings.
Yeah.
And that earnings multiple can expand and contract.
Yes. So one thing to watch out for, though, in a bull market is something called asset drift. Let's say your portfolio starts out with 70% stocks. A long bull market can push that number higher without you even realizing it, making your portfolio riskier than you wanted and realized.
Yeah. Just a very simple example. If you're in a stock portfolio, in an investment portfolio that's 70% stocks and 30% fixed income, and the stocks grow 30% and the fixed income grows 5%, then you're going to be overweighted at the end of that period of time. You're going to be overweighted from your target allocation. So a rebalancing strategy tends to work well over time when that happens.
Yeah.
So wait a second. Jack got to introduce bull markets, but now I have to talk about bear markets.
Wait till you hear what I get to talk about later.
Low man on the totem pole here.
So
yeah, let's talk about bear markets. Picture a bear standing up, swiping down with its claws. That's what happens when stock prices fall by 20% or more. Investors, they start to panic, they start selling, and suddenly the whole market starts to appear more like, say, a ghost town.
Correct.
No bear market starts for the same reason. Such market might coincide with a weakening economy, significant liquidation of securities, and widespread negative investor sentiment. In that weak economy, spending decreases, leading to lower business earnings, and that can impact stock valuations. And while a weak economy may or may not lead to a recession, a bear market can still develop even without a recession.
Correct. Yeah, typically bear markets align with recessions, but not always.
Yeah.
And so the bear markets that we don't have frequent bear markets, and they don't last as long generally as bull markets.
Yeah.
Bull markets are longer and more sustaining. And if you look at markets over time, depending on how you're looking at it, if you're looking at rolling 3-month periods versus rolling 1-year periods, or rolling 5-year periods, or rolling 10-year periods, your perspective is going to be different. But generally, stock prices over time are going to rise and grow along with the overall economy, because the economy is driven by demographics and things of that nature, as in the growth of our economy. And so you would, the markets are going to grow in a corresponding manner. From that, we also develop new technologies and productivities and things of that nature, and innovation that comes into play. So you think about major things of innovation that have driven long bull markets, or things like the internal combustion engine in the early 20th century, things of that nature. You have the internet that came and produced improved productivity, computerization, the power of chips and what drives our computer abilities. There's more computer technology in an iPhone today than there was on the space shuttle.
I know. Isn't that crazy?
It's
We put a
more
man
powerful.
on the moon without the technology that we have in our pocket.
Yeah, they use slide rules. For
I don't even know if I could use a slide rule
for that. Allison, I don't know if you ever talked to your grandfather, who's passed away a number of years ago, but he was on the NASA team that took men to the moon in the 60s.
Yeah.
And in fact, he was the lead engineer on the lunar rover, which was the vehicle they drove on the moon. And they had to recalculate the mission with that rover, because they had to decided they wanted to add fenders, and it changed the weight of the whole mission. And all that was done with hand calculations. It took them actually several days to recalculate the weight of the mission from that. And I
think that is so cool.
Hearing my father-in-law tell that story from what happened in this, it really was kind of fascinating to me.
It's incredible.
All without an iPhone calculator.
Correct. And so they literally used slide rules and stuff, and did manual calculations with all these sheets of paper and stuff. It's so kind of fascinating. So innovation drives markets. And so that's why you have a tendency to have more and longer bull markets than bear.
When you just talked about the bear markets being shorter, since 2010, there have been 2 bear markets, and both of them lasted less than 1 year.
Correct. And typically, the recovery time to make up for the loss in a bear market is generally fairly short. The last big, huge bear market was the one that started in late 2007, went all the way through 2008, and ended in March of 2009. So it was about a year and a half bear market. It was closer to 2 years, actually. I was in the business then. It was not fun, and it was very, very difficult. And the markets fully recovered, I want to say, in about 16 months. It was really rather remarkable. And so generally, there's no magic button to push when you're in a bear market. They're not fun. They're definitely not fun.
So you just got to ride through it.
You ride through it. You stay invested, and you talk with your advisor. If you're adding to your account, so you're in the accumulation phase of life, you're contributing to your 401ks and things of that nature, or your IRAs, do that, because you're buying more shares, because you're buying them at cheaper prices. And so you're accumulating more long-term, more value by doing that.
Yeah, if you have a long time horizon, it's not a bad situation at all, really, to be in a bear market.
Correct.
Yeah, it goes back to that Warren Buffett wisdom: be greedy when others are fearful, and be fearful when others are greedy. This is the greedy when others are fearful part. And, it's funny, when I go into Publix to do our weekly grocery shopping, and we see something that we like, or, Laura likes Cheez-Its right now, and we see Cheez-Its or buy one, get one, we're excited. Because we're either getting 2 boxes or we're getting 1 box half off. And that's good for our wallet.
Laura's excited too.
And Laura's excited too. But, people freak out when the stock market is on sale.
Correct. It's
And, it's kind of counterintuitive, but it can be good for your investment portfolio. And you can be greedy when others are fearful.
Yep. So another thing that that you hear people talk about is volatility in the marketplace.
Oh, yeah. There's one thing that's certain when it comes to investing in the stock market, and that 100% certainty is that there will be volatility.
Correct.
One day the market's up, the next day it's down. So even within bull and bear markets, we have that volatility.
Yeah, exactly.
There's times that the markets tend to have larger swings daily or weekly than others. I think often those you may recall we said that what fundamentally drives the value of markets are earnings.
Mm-hmm.
Well, they don't change that frequently.
Yeah.
And the like. So what generally affects daily fluctuations are the news, geopolitical events.
I like to call it noise.
Yeah, it is. And it is noise. And it does not have fundamental issues with the market. So it drives the daily fluctuation and what that so-called volatility. So when there's more noise, you tend to have higher and wider swings in the marketplace. And when there's less noise, it tends to be a little bit more boring.
The market reactions to some of the Fed meetings
Correct.
always just amazes me.
Yeah.
One little word can
Right.
completely change
The direction.
of the market for the day.
Yeah, it's not uncommon when the Fed makes an announcement on their meetings, and they issue a statement. So it comes out in the statement, and that may move the market a little bit. And then the chairman does a Q&A.
Mm-hmm.
Invariably, in the Q&A, the chairman says something that freaks the press out, and the markets move. And it's usually something that he says that's a little bit reckless and off script from the statement that does that. So you could have a day that, say, the markets are up 100 points in the Dow. The statement comes out, and it's rather benign in the statement, and so that the markets maybe go up to 150 points and that sort of thing. And then the chairman does this Q&A, and about 40 minutes into the Q&A, he says something, and all of a sudden the markets are down 400 points.
It looks like a seismograph after an earthquake.
And at the end of the day, he did not say anything that had any impact to earnings, which is the fundamental driver of the market.
Yeah.
So it's all noise.
There's a lot of overreaction.
There's a lot of noise out there. But what is Warren Buffett's advice regarding market volatility? He's stated before that the stock market is designed to transfer money from the active to the patient. So if you're jumping in and out of stocks every time they move, you're just making Wall Street rich with trading fees. His advice really is simple here. Buy great companies, hold them for a long time, and ignore the noise.
That is, and it is so true. We tend to, our advice is to develop a sound investment strategy and a model to target for your investments, and then stick to it. You periodically rebalance to your target allocations. But you do not try to time the market. It is on a daily basis. It's almost no rhyme or reason as to why the market went up yesterday over 500. At one point, it was up over 500 points. It didn't finish up 500 points, but it still finished way up for the day, and no fundamental.
Yeah, you sit there asking why.
Yeah.
Why?
And I'll tell you why. There were more buyers than sellers.
And if Warren Buffett's not out here trying to time the market, why should we?
Yeah. Like you mentioned, historically, the stock market rewards those who stay invested. And like Jack said, remain disciplined, avoiding making emotional decisions based on that short-term volatility.
Correct.
Okay. So Adrian, you were disappointed that you had to introduce bull market or bear market.
Yeah, you really get the fun one.
I get the fun one here. Let's talk about recessions, because every time the market is down, someone on TV starts screaming, "We're heading for a recession." And it might just be clickbait at this point.
Yeah. In simple terms, it's not the official definition of a recession, but it generally is what most people refer to. A recession is declared when you have 2 consecutive quarters of GDP contraction.
Yeah.
So 2 consecutive negative GDP numbers and quarterly numbers, and that would be a recession. But generally it's an economic slowdown where all of a sudden you have lower spending, businesses are struggling, you have higher unemployment, the economy just is not humming.
Yeah. And some of those signs have kind of been there recently. So perhaps maybe the economy is heading toward a recession, but really only time will tell on that.
I will say this about recessions. Occasionally I'll see somebody on television say we're way overdue for a recession.
Yeah.
And it's kind of like somebody screaming, that, or the old adage that a broken clock is right twice a day.
They get over forecasted.
Correct. And it's almost like in meteorology,
I knew this was coming.
We're way overdue for a tornado outbreak or whatever. At the end, or the same thing. If you flip a coin and it's heads 10 times in the row, is it more likely to be tails
it's
on the
50,
next
50 shot?
It's still 50-50.
Yeah.
So, there's no such thing as being overdue for a recession.
Yeah.
When we were an industrial economy, so you flip back, go 60, 80 years back.
Mm-hmm.
And before that, we were 2/3 of an industrial economy and 1/3 of a service economy. In an industrial economy, you have inventories at multiple levels, a lot of inventories. Because inventories expand and contract, and as the economy grows or contracts a little, that's compounded because of the way inventories expand and contract. And so what happened is almost like clockwork, every 4 or 5 years, there was a recession.
Yeah.
Because of just the economic cycles of just a slowdown, not necessarily a recession would create a recession because of contraction of inventories in the economy. Now that we are more of a 2/3 or more service economy, there's not all these inventories built into the system. So when you have an economic slowdown, you don't have this contraction of inventories that create real hardship at the bottom level of the totem pole in the economy. So as a result, there's nothing that says that invariably every slowdown leads to a recession.
Yeah.
When you were in an industrial economy, virtually every slowdown in a cycle ended in a recession.
Yeah.
And that doesn't happen anymore. So we're never overdue for a recession. Now, will we have another recession? I'm confident that we will someday, but it doesn't mean that you have to have one every 4 years, every 5 years, every 7 years. And if you go back 60 or 70 years and you look at that, you did.
Yeah.
Mm-hmm.
And the reason is because of
the nature of the economy.
The nature of the
different.
economy that doesn't hold as much inventory.
Yeah.
That's kind of a technical economics lesson.
Yeah.
But recessions are not fun. The last significant recession we had was the Great Recession of 2008. And that was driven by a number of factors, but a financial crisis that and you actually could kind of see that coming a little bit. You knew you couldn't see the severity of it, but it was a mess. we technically had a recession in the early stages of COVID
Yeah.
due to the shutdown of the government. But
Yeah.
that recession was very short.
Yes, it was.
Yeah.
So it really was not a normal recession, but technically was a recession
And a very quick rebound.
and a
Yeah.
very quick rebound.
So even when things look bad in a recession, Buffett stays calm. He knows that businesses adjust. People keep innovating. You've talked a lot about innovation and how that's good for the market. And in the long run, the market recovers. He has stated before that bad news can be an investor's best friend. It lets you buy a slice of America's future at a marked down price. Going back to, if you're still in the accumulation phase, the market at a discount is a good thing for your portfolio in the long run. And he believes that economic downturns often present opportunities to acquire quality assets at reduced prices.
Well, I'm going to say this: the people that run the companies that we have an opportunity to invest in are very smart.
Much smarter than us.
They're really, really smart, and they look at what's laid out in front of them, and then they're constantly looking at what is our best path towards profitability.
Yeah.
And capitalizing on the certain circumstances in the marketplace that are out there to improve the profitability of our company.
Yeah.
So as a result, when we're in a recession and the investor community wants to throw their hands up and say, oh, I don't know, this is awful, I give up, and all that sort of thing. The people running these companies are not doing that. They've got their head down and they're looking at it and saying, what do we do? What's the best path? How are we going to improve profitability? How are we going to improve our efficiency? How are we going to drive innovation and that sort of thing? And so it truly is an opportunity when it seems and feels very bleak and our fears are getting the best of us. And our job as financial advisors is to not let your fear get too far ahead of you.
Yeah.
And like we talked about, it's easy to invest when the market is going up. It's a lot more difficult when the emotions start to play.
Yeah. No doubt. Our emotions and particularly fear is a horrible emotion.
Yes.
Yeah. Well, Adrian, let's talk about emotions a bit.
How emotions move the market, investor sentiment. It's how a crowd, say at a sports game, feels about their team. We're recording this in March, so let's talk March Madness here. Imagine you're at a basketball game. Your team just made an amazing shot. Everyone's excited, cheering.
They're standing up. They're on their feet.
Just going wild, believing their team will win. That's like when investors feel good about the stock market. Prices are going up. Everyone's excited, confident. There's no fear. But if your team starts losing, it's a different story.
Yeah. Just the other day, we had the Alabama-Florida SEC tournament game on, and it was neck and neck the whole first half.
Even I was cheering for Alabama.
Yeah. And that says a lot coming from this Florida State fan.
Boo Gators.
But, in the second half of the game, Florida started pulling away and, I started to get quiet. The Alabama fans that were there, I'm sure they were quiet. They get worried. Perhaps some fans even leave early. And that's how investors feel. That's like when investors get nervous and the stock prices drop and people start selling their stocks.
Right. What's interesting is that investor sentiment is measured, and it is something that I look closely at. It's measured, and there's various different organizations that measure investment sentiment. Bank of America publishes one monthly. The American Association of Individual Investors publishes one weekly. And I tend to look at that every Thursday when that comes out. And when sentiment is bearish, that's actually bullish for stocks because it's that individual investors get it wrong.
Yes.
Yeah.
And this data has been out there for a long time that shows. And so typically and here we are, we're recording this in here mid-March, but investor sentiment for the first 3 weeks of March has been awful.
Mhm.
It's
Yeah.
really, really been low. We've had some volatility. We've actually had a correction
Mhm.
in the marketplace. And, a correction is not a bear market. It's basically just a 10% retrenchment of
Yeah.
pricing. And they're very common. Almost every year has at least a correction. So it's not an uncommon thing. But sentiment is very, very low. When sentiment is low and this pessimistic,
Mhm.
Yeah.
the average 12-month return when sentiment is this low is 24%.
Yeah.
So now I'm not saying that the markets are going to be 24% higher than they are now. I'm just saying historically,
Yeah.
when sentiment is this bad, 12 months later, the markets are up 24%.
Yeah.
That's why Warren
It's-
Buffett says the stock market is driven by fear and greed.
That is
Yeah.
correct. And so that's the gist of this, the adage, be fearful when others are greedy and be greedy when others are fearful. So right now there's a lot of fear
Yeah.
Mhm.
in the markets. We had an earnings season for the fourth quarter that was reported with, I think about 2/3 or 3/4 of the S&P 500 met or exceeded their earnings expectations. Over half of them issued favorable guidance going forward.
Yeah.
So from an earnings perspective, there doesn't seem to be anything fundamentally wrong.
Mm-hmm.
But what we have is just overwhelming negative sentiment right
Yeah.
now, and it's being driven by noise.
So the
Yeah.
important thing here is be patient. Don't
patient.
overreact.
Mhm.
Don't freak out.
And try to ignore the noise.
Yeah.
And I will tell you, I'm not a big fan of all of our national media and all of the various cable networks and that sort of thing that try to sensationalize things. They try to make things, they try to get you overwhelmed and overwrought and
Yeah.
angry.
Just watch the weather.
Yeah. Or and so I would, step back and talk to your financial advisor, talk to us. But I think do I think prices or the market is perhaps overvalued? It probably is a little bit overvalued at these levels based on historical valuations, but there's not a reason to be overly pessimistic in my
Yeah.
opinion, at least not to match the level of widespread sentiment out there. So I think that's being driven by noise.
Yeah. So what we've learned today, markets go up, those are the bulls. Markets go down, bears. And sometimes they just freak out. That's your volatility. And investor emotions can drive the chaos. But if we take a page from Warren Buffett's playbook, the secret is simple. Stay patient, ignore the noise, and buy great companies and hold them for a long time.
One of the things that I always love to say about the business we're in is that we're professional handholders.
Yes.
We
We
don't
are.
do,
Mhm.
we're not some sort of brilliant analyst or stock pickers
And we're not
things of that
psychics. We
nature.
don't know what the market's going to do tomorrow or 2 days from now or 2 years from now.
Yeah. And so it is, but we can hold your hand very, very well, and we can help you and guide you through the fear, and celebrate when you, have things to celebrate and everything. But we're professional hand holders. And if that means we need to talk you off the ledge every once in a while, that's okay too. We can do that.
And we have done that.
We have done that, but to bring some rationality into what we do, because at the end of the day, time and discipline are going to be your friend.
That's right.
Yeah.
And that's where we come in, and we want to try to help you do that.
Well, hopefully you found this episode helpful. We would love to work with you in your pursuit of financial wellness. Reach us at info@eaterfw.com, or you can call us at 205-510-9072.
And we hope you do.
Yes.
Yeah.
All right. Well, thanks so much. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the BamCam podcast with Jack Burnette and Alison Castellano from Eater Financial Wellness, a financial advisory practice at RFG Advisory. To get in touch with us, visit today's show notes or go to our website at www.eaterfinancialwellness.com. That's ITER financialwellness.com. And please click the follow button to be notified when new episodes become available.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guest nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory or RFG, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.